In his first major economic message, President Donald Trump declared success in curbing inflation within the administration's first 100 days, pointing to a marked decline in prices of everyday essentials, specifically eggs and cooking oil. The claim coincides with a nearly 20% drop in oil prices since Inauguration Day, a notable trend despite ongoing instability in the Middle East. However, energy market analysts attribute this decline more to increased U.S. production and global supply-demand rebalancing than to direct presidential action. While lower prices in food and energy can ease household cost burdens and boost short-term consumer confidence, economists emphasize these components are highly volatile and do not represent structural inflation improvements. In fact, the Federal Reserve and major financial institutions rely on core inflation, excluding food and energy, to assess long-term trends. During this period, core inflation remained stable, indicating that the broader economy had not undergone a fundamental shift. Nonetheless, politically, the administration's framing proved effective. Lower prices on staple goods generate strong public resonance, particularly among working-class Americans, reinforcing the image of a presidency delivering quick economic wins. Since President Trump's inauguration, oil prices have fallen nearly 20%, a surprising development given the persistent instability across the Middle East, traditionally a driver of price spikes in global energy markets. The decline underscores a shift in global oil dynamics. Surging U.S. shale production, combined with softening demand growth in China and Europe, has outweighed the geopolitical risk premium that typically inflates prices. Analysts from Bloomberg and Reuters note that market fundamentals, particularly supply resilience and inventory levels, now play a more dominant role than regional tensions alone. This price softness offers short-term relief for consumers and industries dependent on transportation and logistics, but it also puts pressure on oil-exporting nations whose budgets rely heavily on crude revenues. For the U.S., lower prices may aid economic momentum, but they also raise concerns for domestic producers operating on tight margins. The Trump administration is expected to leverage this trend to further promote energy independence and deregulation. Chevron chairman and CEO Mike Wirth appeared on the program to weigh in on America's pursuit of energy independence, an agenda central to both the Trump administration's economic platform and broader national security policy. His presence underscored the strategic role of major oil producers in shaping domestic supply chains, infrastructure investment, and regulatory outcomes. Chevron, one of the world's largest integrated energy companies, stands at the intersection of public policy and private sector execution. The conversation came at a pivotal time as the U.S. ramped up shale production and positioned itself as a net energy exporter, reshaping traditional dependencies on OPEC and shifting leverage in global energy markets. Wirth emphasized the need for stable, long-term policies that support capital-intensive energy development while balancing environmental and geopolitical risks. As energy independence becomes more than a slogan, corporate leadership and policy alignment will be key to sustaining America's competitive edge in a volatile global landscape. Mike Wirth, CEO of Chevron, cautioned that the U.S. first-quarter GDP figures were distorted by technical import-related factors and do not accurately reflect underlying economic conditions or recession risk. According to Wirth, the reported slowdown was driven in part by a surge in imports ahead of potential trade policy changes, temporarily widening the trade deficit and pulling down net GDP. This phenomenon, often referred to as residual seasonality or inventory frontloading, has been a recurring distortion in early year data. Economists at WSJ and Bloomberg have flagged this as a long-standing measurement issue in US GDP accounting. Wirth's remarks highlight a critical nuance in macroeconomic interpretation. Headline GDP prints can mislead if structural anomalies aren't adjusted. As such, businesses like Chevron rely on operational metrics, such as energy demand and capital flows, rather than quarterly GDP alone. In a market sensitive to economic sentiment, this technical clarification helps avoid overreaction and reinforces the case for a more stable, fundamentals-based outlook. Despite concerns over GDP softness, Chevron CEO Mike Wirth emphasized that energy demand remained strong in Q1, a key operational indicator suggesting underlying economic resilience from the corporate perspective. Unlike top-line GDP figures, energy consumption reflects real-time industrial activity, transportation usage, and household utility demand, making it a proxy for broader economic engagement. This steady demand supports the view that core sectors, such as logistics, manufacturing, and consumer mobility, continue to operate at near normal levels, despite policy uncertainty and external volatility. For energy producers, this stability justifies sustained capital investment, protects employment, and offsets fears of an imminent cyclical downturn. It also reinforces confidence in the US market's capacity to absorb temporary macro shocks. Chevron stands as the sole remaining American energy company still operating in Venezuela, maintaining its presence after more than 100 years, in a country once considered a key strategic partner in US oil supply chains. This long-standing footprint, amid widespread US corporate withdrawals, reflects Chevron's calculated effort to preserve strategic assets in one of the world's largest oil reserves. Even as the political and economic climate has deteriorated dramatically, Venezuela's collapse under hyperinflation, US sanctions, and authoritarian governance drove out most Western energy firms. Yet Chevron maintained a narrow operating license from the US Treasury, allowing limited activity in compliance with sanctions. The decision to stay is not without risk. Asset expropriation, payment issues, and reputational exposure remain persistent threats. However, it positions Chevron uniquely for a potential post-crisis recovery should Venezuela re-enter the global oil market under new leadership or reform. Strategically, this presence also serves US interests by keeping at least one Western-aligned player on the ground, limiting the vacuum for Russian and Chinese oil firms to expand unchallenged. The US ban on crude imports from Venezuela has introduced a critical vulnerability to national energy security, particularly impacting refineries along the Gulf Coast that are technically calibrated for Venezuela's heavy sour crude. Unlike light sweet crude from US shale, Venezuelan oil possesses the high-sulfur, high-density profile required by legacy infrastructure in Texas and Louisiana, built over decades for this specific feedstock. This mismatch forces refiners to seek alternative heavy crude sources from countries like Canada or the Middle East, often at higher cost and with longer shipping routes, reducing both economic and logistical efficiency. Chevron, the last US operator in Venezuela, previously helped balance this supply chain. The loss of Venezuelan imports amplifies exposure to global disruptions and undermines the strategic flexibility of America's refining sector. Energy experts warn that the move, while politically justified under sanctions, may erode resilience in the US downstream sector if replacement strategies are not swiftly implemented. China has emerged as Venezuela's largest oil customer, significantly increasing crude purchases at a time when Western firms have exited and US sanctions remain in effect. This strategic engagement allows Beijing to secure discounted oil while deepening its leverage over a country once tightly aligned with US energy interests. Chinese state-owned firms, often backed by long-term credit lines and infrastructure agreements, are filling the vacuum left by Chevron and other Western players, embedding economic dependence in exchange for lifeline financing. The shift poses broader geopolitical implications. China is not just purchasing resources, but actively expanding its strategic footprint across Latin America through energy diplomacy. This growing presence near the US sphere of influence could reshape regional alliances and limit Washington's ability to counter authoritarian regimes through economic isolation. Should Chevron withdraw from Venezuela, the resulting vacuum would likely be filled by Chinese and Russian state-backed oil companies, expanding the geopolitical reach of Washington's strategic rivals within the Western Hemisphere. Both China's CNPC and Russia's Rosneft have long sought greater access to Venezuelan reserves, and a Chevron exit would remove the last significant US foothold in one of the world's largest crude basins. This shift would accelerate energy alignment between Venezuela and authoritarian regimes, reducing US visibility and leverage in a region once dominated by American energy and security policy. From a national security lens, such a scenario compromises not just energy interests but also intelligence, supply chain resilience, and hemispheric influence. Experts warn that ceding ground to geopolitical adversaries so close to US borders may carry long-term costs that far outweigh any short-term economic or diplomatic wins. Mike Wirth issued a clear warning, allowing foreign powers, particularly geopolitical competitors, to expand influence in regions close to the US, undermines long-term national interest and weakens America's strategic positioning. The concern reflects a broader shift in global alignment. As US firms scale back operations in politically unstable zones, rivals like China and Russia are stepping in, leveraging state-backed capital and long-term agreements to secure energy, infrastructure, and soft power. Wirth's remarks go beyond commercial implications. They echo long-standing US security doctrine that proximity matters, especially when authoritarian states seek footholds in America's backyard. Allowing this encroachment risks strategic blind spots, energy dependency, and diminished diplomatic influence. It also complicates Washington's ability to respond to crises in the region or shape multilateral outcomes. In a volatile global environment, maintaining influence close to home is not just symbolic. It's foundational to preserving economic and national security resilience. China is replicating a well-documented financial strategy across Latin America, extending large-scale infrastructure loans in exchange for long-term resource access and political influence, a pattern previously observed in Africa and Central Asia. Often referred to by Western analysts as a debt trap strategy, this approach enables Beijing to embed itself in national economies through opaque lending terms, collateralized by oil, minerals, or state-owned assets. The result is growing dependency. When borrower nations fail to meet repayment terms, China is positioned to extract favorable concessions, ranging from policy alignment to strategic infrastructure access. This model has sparked concern among US officials and global financial institutions, who warn that such practices erode sovereignty, bypass multilateral norms, and undermine long-term economic resilience. In Latin America, the replication of this model further complicates US efforts to maintain strategic balance in its own hemisphere, especially as local governments accept near-term capital in exchange for long-term alignment. The Trump administration has acknowledged China's growing use of debt diplomacy and is actively pursuing measures to curb Beijing's influence over economically fragile nations. This strategic shift reflects heightened awareness in Washington that unchecked Chinese financing, especially through opaque, state-directed lending, can entrench authoritarian influence and undermine Western-aligned economic norms. In response, the US has begun offering alternative financing frameworks via institutions like the Development Finance Corporation (DFC), while tightening scrutiny of international deals involving Chinese state-owned firms. Diplomatically, the administration has stepped up pressure on allies and multilateral partners to avoid falling into unsustainable debt agreements, emphasizing transparency, sovereignty, and long-term economic sustainability. By elevating this issue to the core of its foreign economic policy, the Trump administration sought not only to protect U.S. strategic interests, but to shape the rules of global finance in a way that limits Beijing's economic coercion. President Trump issued a sweeping directive to all countries: immediately cease all purchases of crude oil and petrochemical products from Iran, or face secondary sanctions from the United States. The move marked a dramatic escalation in the administration's maximum pressure campaign against Tehran, aiming to choke off its primary source of revenue and curb its regional ambitions. Secondary sanctions, targeting non-US entities doing business with Iran, extend Washington's leverage beyond its borders, compelling foreign governments and corporations to choose between access to American markets or continued dealings with Tehran. Analysts note this approach creates legal and commercial uncertainty, especially for Asian and European refiners still reliant on Iranian crude, while simultaneously deepening geopolitical rifts with China, India, and the EU. The enforcement of such extraterritorial measures underscores the global reach of US financial dominance, but also risks backlash from allies increasingly wary of US-centered global rules. Chevron CEO Mike Wirth emphasized a critical principle in international sanctions policy. Economic pressure only delivers results when enforcement is serious, consistent, and uncompromising, something previous US administrations failed to maintain. He pointed out that weak or inconsistent application of sanctions undermines US credibility, allowing targeted regimes to adapt, reroute transactions, and continue financing destabilizing activities. In contrast, the Trump administration's aggressive stance, backed by secondary sanctions and financial isolation, sent a clearer message to markets and adversaries alike. For corporations like Chevron, enforcement clarity reduces legal ambiguity, enabling more decisive planning in volatile regions like Venezuela and Iran. Ultimately, Wirth's remarks underscore that sanctions, when half applied, become diplomatic theatre. Real impact requires real action. Chevron is engaging in constructive discussions with the US government to streamline permitting processes and reduce bureaucratic delays, steps it views as essential to unlocking long-term investment and strengthening American economic competitiveness. CEO Mike Wirth highlighted the need for legislative and administrative reforms that would modernize infrastructure approval, improve capital deployment timelines, and enhance investor confidence in US-based energy and industrial projects. These reforms are particularly urgent as the US seeks to compete globally for capital in energy, manufacturing, and logistics, sectors increasingly constrained by regulatory complexity and permitting backlogs. Chevron's support aligns with broader industry calls for a once-in-a-generation modernization of federal permitting, including clarity on environmental review standards and interagency coordination. Ultimately, improving permitting efficiency is not just about oil and gas, it's about maintaining US relevance in a global economy where speed, scale, and certainty increasingly define competitiveness.